Chapter 3 Homework. Question number 1. The first thing I try to do is look at the bottom of the question to see what information we're going to be calculating. It looks like we'll need to calculate the average selling price, average variable cost, contribution margin, break-even point, and number of tickets. So now let's read the fact pattern. Waterman's Waterworld Tourist Park has the following information. We have total revenues of $2 million, fixed costs of $546,875, variable costs of $1,125,000, and total tickets sold of 50,000. This question looks pretty straightforward, so let's begin. The average selling price for a ticket, we have $2 million in total revenue, and we divide that by the total number of tickets sold. That gives us $40 per ticket. Next, the average variable cost per ticket. Our total variable cost is $1,125,000. Divide that by 50,000 tickets, and we get $22.50 variable cost per ticket. C is the average contribution margin. Remember, average contribution margin is sales price minus variable cost. Remember that this is the amount that each item contributes to the total profit or the bottom line figure of the company. So our sales price per ticket was $40 minus $22.50 in variable cost equals $17.50 contribution margin. Next is break-even point. Break-even point is the number of items, or in this case, tickets that need to be sold in order for the company to break even. For a company to break even, all of its fixed costs need to be covered, and then any tickets sold above that point is going to yield some profit. The fact pattern tells us that we have fixed costs $546,875, and we know that each ticket sold gives us $17.50 towards the bottom line of the company. That's $17.50 contribution margin. So we divide $546,875 by $17.50, and we get 31,250 tickets. So the company has to sell 31,250 tickets, and after that point, they start making profit. And then part E says that the company needs to earn at least $140,000 in operating profit, or they will close down. So we need to figure out how many tickets need to be sold. So each company is in business not to just break even, but to hopefully make a profit. Investors need to make a return on their money. It doesn't matter if you're investing in a business or you're investing in your savings account at the bank. You want a certain amount of return on your money. So for this Waterworld Tourist Park, they probably paid millions of dollars to open and build this park, and so they've determined that they need to make at least $140,000 in operating profit a year so that the money invested is earning a reasonable rate of return. So we already know that we need to sell at least 31,250 tickets to break even, but how many more tickets do we need after that to earn a profit of $140,000? We take $140,000, divide that by the contribution margin, which again means that we make $17.50 of profit per ticket sold above and beyond the break-even point. And that gives us 8,000 tickets. So that means that we have to sell our 31,250 tickets and sell an additional 8,000 tickets to get to a grand total of 39,250 tickets. So again, we need to sell 31,250 tickets to break even accounting-wise, but we need to sell an additional 8,000 to achieve a certain level of profit that we need in order for the business to be worthwhile. So that's question 1. Question 2 is very similar, so I'll let you guys work on question 2 on your own. For question 3, we're comparing two different companies. We have Cousins Company and Jones and Family. Cousins Company has heavy variable costs, so their contribution margin ratio is 25%, and their fixed costs are $450,000, which means that for every dollar of items sold, they make 25 cents as long as sales are over the break-even point. For Jones and Family, they have higher fixed costs, so their variable costs are relatively lower, so their contribution margin ratio is a lot higher. So they make 75 cents profit for each item sold above the break-even point. Their fixed costs are much higher than Cousin Companies. Their fixed cost is $2,325,000 versus just $450,000 for Cousin Companies. And both companies have the same amount of sales annually, $3,750,000. So we're going to compare the two companies. We'll do Cousins Company. The sales for Cousins Company is $3,750,000, which is the amount given to us in the fact pattern. This is 100% of their sales. Their variable cost is 75% of sales, and their contribution margin is 25% of their sales. So the math is $3,750,000 of sales times 75%. That equals $2,812,500. For the contribution margin, you can either do $3,750,000 of sales times 25%, or you can do $3,750,000 of sales minus the variable cost of $2,812,500 to arrive at $937,500. We know that fixed costs are $450,000. So $450,000 divided by $3,750,000 equals 12%. So our operating profit is the contribution margin of $937,500 minus our fixed cost of $450,000 equals $487,500. And then to calculate the percentage, we do $487,500 operating profit divided by total sales equals 13%. Next, we'll work on Part B of Cousins Company. Part B says, suppose that the company experiences a 12% decrease in sales volume. How much would each company's profits decrease? So to figure that out, we have $3,750,000 in total sales, and we have a 12% decrease. So that means our sales are going to decrease by $450,000. Our contribution margin is 25%. So that means that our profits are going to decrease by $112,500. So that's Cousins Company for number 3. I'll let you do Jones Family, Part A and B on your own. Question number 4 is also very similar to question number 3, so you guys can work on that one on your own as well. Questions number 5 and 6 deal with break-even point again, but also margin of safety. So again, break-even point is the number of items that need to be sold to cover all of your costs, variable and fixed. But most business owners aren't going to be comfortable aiming for a break-even point. They want to aim a little bit higher. Just in case something happens, they have a bit of a cushion. Sometimes expenses are higher than budgeted for, so it's usually better to aim for a minimum margin of safety so that we have a little bit of breathing room in case something unexpected happens. So for question number 5, it says that this tour company offers historical and architectural tours. They charge $350 per trip. The variable cost for the tour is $42. You have to pay for the fuel and the driver. And the fixed cost for the company every month is $13,860. So part A is how many tours must NCT sell every month to break even? The book gives us a formula which is profit equals sales price minus variable cost. multiplied by the number of trips or the number of items sold minus your fixed costs. So for break-even point, we have zero profit. So we need to put 0 for our profit amount in the formula. We know that the sales price per trip is $350, and we have $42 in variable cost multiplied by the number of trips minus fixed costs of $13,860. So to do the math, we're going to move the $13,860 to the left side of the equation, so it becomes a positive $13,860. $350 minus 42 is $308, which is our contribution margin, times the number of trips. Then we divide both sides by $308 to arrive at 45 as the number of trips. So our break-even number of trips is 45. Part B says that 50 tours is a reasonable forecast of the average monthly demand. So what is our margin of safety? Well, we do 50 trips minus 45 trips. That equals 5 trips. So 5 out of 50 trips is a 10% margin of safety. So for part B, we're going to put in the number of tours needed, and that's 5 tours. Question number 6 was very similar to question 5, so we'll skip 6. But we'll work on number 7. Number 7 also deals break-even point, but it adds another layer of complexity because instead of one item to be sold, we're selling 2 items. Or in this case, we are preparing 2 different types of returns. We're preparing tax returns with standard deduction versus tax returns with itemized deductions. The fact pattern tells us that out of all the returns that we prepare, 25% of the returns use standard deduction and the other 75% must use itemized deductions. And they want us to calculate how many returns we need to prepare to break even. So the formula for this question can be found on page 109. We need to calculate the weighted average contribution margin per unit. But first, let's calculate the contribution margin per each type of return. So for the standard deduction, we have a $50 sales price, $10 in variable cost equals a contribution margin of $40. For the itemized deductions, we have a $250 sales price minus $30 in variable cost to arrive at $220 contribution margin. So for each return that we prepare, we're either going to make $40 in profit or $40 contributed towards the bottom line or $220 profit. So since we do a mix of returns, we know that our profit is going to be higher than $40, but it's not going to be all the way up to $220 because we do some standard returns as well. So our profit needs to be somewhere in the middle. Our contribution margin needs to be between $40 and $220. And we need to figure out what the exact number is. This is a good test-taking skill to have. You have to be able to reasonably guess what your answer is going to be. So on a test, if you're calculating the weighted average contribution margin of 2 units, and you know one unit's profit is $40 and the other unit's profit is $220, your weighted average margin needs to be between those 2 numbers. So if you get an answer of $1,000 or $2,000 or $20, you know that you messed up somewhere because you're not within that range. So let's continue. The question tells us that 25% of our returns use the standard deduction. So we do 25% times the sales price, which is 50, minus variable cost of 10. And then we add that to our itemized deduction returns. 75% of our returns are itemized deductions. We take the $250 sales price minus the $30 variable cost, which gives us a weighted average contribution margin of $175. So again, we know that we make $40 profit on each standard deduction return that we do. We make $220 on every itemized deduction return that we do. But since we do a mix, on average, we're going to do $175 profit per return. So again, we use the equation, which is that profit equals the price minus the variable cost times the number of units minus fixed costs. And since we're calculating the break-even point, our profit is 0 at that point. We know that our price minus variable cost is the same as contribution margin, which we already calculated. Our contribution margin is 175. We multiply that by the number of units that we need. We don't know that yet, but we do know that our fixed costs are 262,500, which was given to us in the fact pattern. So we move the 262,500 to the other side of the equal sign. Now we divide both sides by 175. We calculate that we need 1,500 returns to break even. But we have to go a step further. We need to calculate how many of these returns are standard deduction returns and how many are itemized deduction. So standard returns are 25% of what we do. So if we do 1,500 returns times 25%, that gives us 375 standard returns. And for itemized returns, we just take the total amount, 1,500 returns, times 75%, and that gives us 1,125 itemized returns. So question number 7 was a little bit trickier because it added another layer of complexity since we had 2 types of services instead of 1, and each service had its own contribution margin. But overall, the question is very logical, and if you need to bookmark page 109 for reference on your homework and on the test, please do so.